the earnings season, and that has officially kicked off today with India's largest software provider TCS declaring their second quarter numbers. Most numbers are beating estimates this time for TCS, but the net profit has crossed 10,000 crore rupees. It has been reported at 10,431 crores. In fact, it's the first time the company has crossed the 10,000 crore mark. Attrition has come in at 21.5%. And at that level, it is higher than the previous quarter. The employee addition, though, is showing a downward trend. And the management says that they are likely to see softness in demand given the economic slowdown that we are seeing globally. Let's listen in to what the management said. What was their commentary after those numbers were put out?
What is important is that what COVID also proved was that technology is at the core of transformation, whether it be on the growth side or it be on the efficiency side or on the resilience side. So across all three dimensions, technology is the core. It's also important that we have built our portfolio to be relevant to customers across the full spectrum of all three of these challenges. So that's where the strength that we are experiencing is coming from. But of course, the overall environment, as I said, we need to remain very vigilant and bears watching. We are, at the end of the day, very focused on a set of customers that we serve. And we try to stay very relevant to those customers and make sure that we are within them. What happens next year in terms of budgeting, we will get to know only 3 to 6 months down the line.
Overall, the demand environment, as Rajesh mentioned, is quite good. And across geographies and as well as vertical segments. But there are some softnesses that it is to be expected. That especially when it comes to the question of long-term deals, long-term decision making, it's only natural to expect certain amount of softness given the overall macro environment.
Well, yes, operationally speaking, TCS has delivered a good set in Q2 FY23, and that's because the rupee revenue has come in better than expectation at 55,300 crore rupees at 4.8% growth versus the 4% growth that we were expecting. The dollar revenue growth at 1.2% is also better than expected, and the constant currency growth at 4% is much better than the 3.2% that we were penciling in. Even on margin front, there has been an improvement sequentially. We were expecting a number of 23.9%, so that has come in line with expectation at around 24%, and consequently the profit is looking healthy at around 10,430 crores. In terms of the other internals, the two important things to watch out for IT companies, which become the lead indicator of growth, is the deal pipeline as well as headcount addition. Now, in terms of the deal pipeline, that has come in at $1 billion, which is flattish on a quarter-on-quarter basis, and this is something that the company had guided that going forward the deal win rate is going to be between $7 to $9 billion, and it's bang in line with that estimate. Even in terms of the headcount addition, it has slowed considerably. Now, if you remember last year, the average quarterly addition was around 25,000 headcount. This time around in Q2, they have added a headcount to the tune of 9,840 crores, and that at a time when the attrition rate has actually jumped up. So the attrition has come in at 21.5%, and that compares to 19.7%. So on one hand, we have the fact that attrition is going up, but the headcount addition continues to slow down, and that is what is worrying the street, that the growth outlook for FY24 can be challenging. However, having said that, the commentary from the management is rather positive. The commentary coming in from the headcount on the headcount front suggests that this is perhaps the worst of attrition figure. On the margin front, the CFO says that they are all poised for a growth here on. They have already seen the worst of the margin pressure, and they say that headwinds from supply side challenges are abating. So that sets up well from the second half of the year, and they're also talking about how they're on track to meet their operating margin guidance of the year. Even if you hear the word coming in from Rajesh Gopinathan, he says the demand for our services continues to be very strong. So overall, have to say that the management commentary continues to be positive. The Q2 performance is strong, but the street is still taking it with a pinch of salt, given the headcount addition and deal pipeline are not very impressive.
Right, so perhaps the street is taking it with a pinch of salt. We'll get further perspective on that. Mahantesh Sabarad is an independent market expert, and he's joining us on the TCS numbers and what it really says about the IT sector. Because yes, we are kickstarting the earnings season with TCS numbers. Mahantesh, how much do you think we should take TCS's numbers as a sign of other reports from India's IT sector? Do you see signs in this report card that suggest that the sector could be getting back on its feet again? Because the commentary from the TCS management does sound pretty positive, doesn't it?
I would reckon that the commentary does point to the fact that we have steady business ahead. The results are not too great, really speaking. While the margins have improved sequentially, the dollar revenue growth is something which is of a worry. While constant currency growth may have improved, you should remember that this quarter has been particularly punishing when it comes to ex-dollar currencies, and that's really affected, I believe, the business for TCS. So that's why if you look at just the dollar revenue growth, it's just about 1.2, 1.3% quarter on quarter. That's a pretty low number. And the book to bill ratio is still hovering at 1.2, which doesn't show any improvement in terms of business sentiments right now, or the prospects of business improving going ahead. Of course, your comments, you've also mentioned about how the overall attrition rate is high, and the number addition to the headcount has been pretty poor. It's less than 10,000 employee addition, which is a pointer of the fact that probably we will have a steadier business ahead and not something that tells us we are poised for a growth.
Fair enough. And what about, because you did talk about that a bit, about cross-currency headwinds right now as you see it, since the rupee has depreciated against the US dollar, even though it has appreciated against some other currencies like the euro, like the sterling pound. How will that play out for the other players as well? Will there be margin tailwinds from the rupee depreciating?
So there are two effects that you will notice. One is that the rupee depreciation, when translated into Indian rupees, appears to be quite positive. That's why we find that the rupee revenue growth has been strong. But when you normalize that on a base currency like dollar, you will see that the margin headwind still remains. We are at 24% as far as the company's margin is concerned for this quarter, and that 24% is something that the company had achieved way back in Q1 of FY21. That's almost 9 quarters ago, barring the recent quarter of June where it was the lowest. So this is the second lowest operating margin number in percentage terms for the past 9 odd quarters, which doesn't tell you that there's some health that has been regained by the business. And the fact that your big book-to-bill ratio is still around 1.2 doesn't tell you that the growth is set to recover. So I would say that the headwinds, currency headwinds, is the primary factor that's showing into the margin number, which is not too great right now.
And what is your general sense on the demand outlook for the IT sector when budgets from European firms they look all set to be slashed in the wake of all the recessionary trends, the energy crisis? Do you see these deal wins taking a hit? Will that reflect in muted growth in the TCV, the total contract value?
It's difficult to say at this point in time because, we need to look at further numbers that keep coming out from TCS ahead. TCS is a large company, let's acknowledge that, and it has the wherewithal to strike deals across the globe. So if there is weakness on the European front, there will be strength that will come from, let's say, the US front. So there is a compensatory effect that will come into play. But what I can see or what I can sense from what the management is talking about in terms of softness of demand tells me that the growth is not going to accelerate pretty much soon. And the headcount is a worry. If headcount is a harbinger of what the company's abilities are in terms of its own future growth and confidence thereof, it tells us that we better be a little cautious about the upcoming year FY24.
Also, in previous quarters, Mahantesh, margins have been under pressure in light of the visa costs, wages going up in the first quarter we've seen. So operationally, do you see stark differences in the way that companies have been performing, just operationally?
See, operationally, what has happened is that the margins had substantially been elevated for the past 2.5 odd years. That elevation in margin came from the fact that there were more uh, transformational projects coming in, more digital projects, revenues coming in, and different kind of revenue streams coming in. That trend has either stalled, I would rather say not really stalled, but has started decelerating. And therefore, you will not see an accretion to the margins until the revenue profile vastly changes. Right now, there are no indications that tell us that the revenue profile is changing for the better, so that we can look at better margins ahead. The only sign of better margins ahead is when currencies stabilize vis-a-vis the dollar.
And as far as sectoral performance is concerned, because BFSI is going to be down, retail is likely to be down, do you find them doing well in certain sectors, or they might just hold up? I'm looking at the IT sector as a whole, not just TCS, because we're looking forward to other earnings in the IT sector too. What are your expectations on their sectoral performance and also their geographical performance? Because in terms of Latin America, they have the revenues that have come in for TCS, at least this time, is 19%. So in terms of what the geographies can do for various companies within the IT sector, at least the big ones, where are your expectations pegged?
So if you compare TCS with the other companies, Indian IT companies, then the geographical spread for TCS is wider relative to any of the other companies. And that's why I mentioned in my earlier answer that TCS will be able to offset any weakness in a particular region. I said about Europe that is oncoming, offset that by revenues from let's say the US. But the regional variations that we are seeing that TCS is showing up is not reflecting a big change. It does tell you that from a regional perspective, TCS's spread is near similar to what it has been for the past several years. And it's only from the perspective of sectoral breakup of revenues that you will notice that unless let's say the BFSI sector starts doing better, the margin improvement scope and the acceleration in growth, particularly on the top line, will continue to remain a bit muted. They will not reach that